Thank you, everyone, for joining us today. We've got your host, Carl Grund, who's a certified financial planner and does individuals and 401ks. Today's panelists are from Franklin Templeton. We've got Kyle Giesting and Kathleen Anderson, who Kathleen is going to be talking about the ClearBridge report that has accurately predicted 6 of the last 8 recessions. So take it away.
Thank you, Emily. Thank you, Carl, for the invitation to be here as well. As mentioned, my name is Kyle Giesting. I do represent a firm known as Franklin Templeton Investments. You may know us through the years, traditionally been recognized for growth equity vehicles at a reasonable cost, as well as a wide variety of different fixed income funds as well. But we also are joined by somebody from ClearBridge Investments, and that's because Franklin Templeton acquired a firm named Legg Mason at the beginning of 2020. And with that change, we are now the 6th largest asset manager in the world. At last check, it was at 1.5 trillion assets under management. And our organization has 1,300 investment professionals located in about 70 different offices around the globe. So we are proud of the scale that we can bring to clients, but also the boutique feel that we can also provide as well. I partner with financial advisors like Carl to offer, solutions based on the current market environment. And that's why I asked Kathleen to join me today. Kathleen, I believe you've got 26 years of industry experience. I think your formal title is you're a director, client portfolio manager. Traditionally, I think you were based out of Baltimore, still out of Baltimore, correct? And works predominantly communicating the viewpoints of ClearBridge Investments. Kathleen, you're going to talk about the anatomy of a recession program today, but if I missed anything, by all means, fill in the blanks there. I'll turn it over to you.
No, you covered it all. And I used to wear that badge of honor of, 25, 26 years in the business. Now I'm like, oh, it's just showing how long I've been in the business. So good or bad, I've seen many different market environments. I guess one of the other things that I would say about ClearBridge, as it may or may not be a household name for some, and as Kyle mentioned, the Franklin Templeton transaction, we've been part of Franklin for 18 months or so now, and it's been very good for ClearBridge. I will say under our previous parent company, which was Legg Mason, and we were based in Baltimore, and so I'm still based in Baltimore with some of my team. ClearBridge is based in New York, is where our headquarters are, and we do have offices around the United States. So depending where you are, if you're close to Baltimore, yeah, you should. If you have any inkling, you hopefully could see our office building in the Inner Harbor area. We have offices in San Francisco, Delaware, Wilmington, Delaware, New York again being our hub. We also have some offices outside the United States, so in London and in Sydney, Australia. And real fast before I do get into the presentation, at ClearBridge, we do manage about 200 billion of the 1.5 trillion that Kyle talked about. That's under the whole Franklin Templeton umbrella. And what I would say is for our shop is if you think about the Morningstar style boxes, so basically large cap, mid cap, small cap, and if you do it on a style basis where it's value, core / blend or growth, we pretty much fill all those style boxes. The only product we don't have is a mid value. And then we also have international and global strategies. So we do, I will say, fortunately have the ability to have a pretty broad view across the markets. What I'm going to talk about today is more directly associated with the US equity markets. So what I'm going to do right now, and hopefully you are seeing my screen that is part of our broader presentation, as Kyle mentioned, is our anatomy of recession. But before I get into our recession risk dashboard, one thing I did want to point out today is because we are, I would say, especially since COVID, the lockdowns, and I would say the subsequent reopenings, I would say the falters that we've had with different variants of COVID, that we've had a very volatile market. And when we came into 2022, we did expect volatility to remain relatively elevated. The one thing that I think is really important to understand is how people react to that volatility and what happens out there. So the titling of this slide, and hopefully this hits home for a lot of people, is volatility does not equal a financial loss unless you sell. Essentially what this chart is showing you, going back to the early 1980s, The gray bars are essentially showing you the calendar year returns that the S&P 500 on a total return basis delivered throughout that year. So you can see, for the most part, you've had positive returns from the S&P 500 going back almost 40 years. Now, what's interesting is those little, I would say aqua or maybe turquoise colored boxes are essentially showing you that there is within any calendar year time period, we as investors will have to endure, I would say, periods of downturns. So on average, anytime between over the last 40 years, on average, we've experienced at least close to a 10% intra-year, I would say, price decline of the market. So I know coming into this year, the market hasn't started out very favorably. If you look at the S&P 500 on a year-to-date basis, we're down about 12%. I know we're up a little bit today, so down between 11 and 12%. The NASDAQ's down about 20%. What I would garner from that is this is something that's normal and what we experience year in and year out. Sticking to, I would say, investment plans, and again, talking to Carl and Emily in terms of how you're putting your portfolios together, just understand to enjoy those gains of an average of about 16%, we do endure, I would say, some down market volatility. Again, those losses are not felt unless you actually sell, so realize that. So I just wanted to bring this chart up because I do think it's important, especially with how returns have been delivered thus far in 2022. Now, one of the other things that we spoke about at the beginning of this presentation is we have a program at ClearBridge called Anatomy of Recession, and it's a rather lengthy, I would say, presentation on markets and economics. Within the presentation, we have what we deem as our recession risk dashboard, and that is what's shown right here. Essentially, what this dashboard does is, I would say, gives us the ability to understand where we are in the economic cycle. And really, what I would say the objective of the dashboard is to really help us understand what the probability of a recession is over the near to intermediate term. And so if you want to think about timing, typically that's over the next 6 to 12 months. The recession risk dashboard essentially follows along the 3 fault lines, what we would deem as the areas that influence the economy. So the first fault line is on the consumer. If you think about it, I would say the economy, the consumer represents about 70% of the economy. So it's very, I would say, influential in terms of how the economy moves forward. Business activity, this is really on the corporation side, the hiring side, so affects labor and those types of things. And then on the financial aspect, this is essentially talking about how, I would say, tight or loose monetary conditions are within the market. So as you can see, there's 12 indicators here. They essentially follow what we would deem as a green, yellow, and red light, I would say, type of progression. So very similar to a red light progression. Typically, when the dashboard is green, means we're in an expansionary environment. Yellow, just like when we're coming to a red light, when it turns yellow, you get a little bit more cautious. You're putting your foot on the brake. And then red is recessionary. Throughout these indicators, they all have their own individual scoring. They are not equally weighted, largely due to the fact some of our indicators are better at predicting a recession. And then I would say the time to a recession when it does turn red. So right now, if you look at all of our indicators and the overall reading for our dashboard is still solidly in the green. You will note that there are 2 indicators here that are a little bit weakened. Wage growth is showing recessionary right now, and money supply is yellow. Again, wage growth is one of our top 3 in terms of weightings within the dashboard, and money supply, I would say, is in bottom 3. But the overall reading for our dashboard remains solidly in the expansionary phase. The one thing that I would say is really helpful about the dashboard is typically when we're about to go into a recession, the dashboard typically turns yellow about 8 months ahead of the recession occurring, and it turns red 5 months later, so 3 months prior to a recession occurring. So as you can see today, we're solidly in the green. Just to address one of the ones that is obviously flashing the red, so recessionary, is wage growth. Even though it's in our top 3, I would say the indicator is usually a very longer leading indicator for us. Wage growth typically doesn't reset into the green until we experience a recession. I would say, given what we went through with COVID and having the shutdowns and starting to get rehiring and a lot of the stimulus, and I would say the extra unemployment insurance has basically expired, we could see this indicator for the first time moderating, maybe getting back to a yellow, possibly a green, without going into a recession. Even if that does not happen, typically wage growth is, when it turns red, it's usually about 2 years ahead of a recession. So a very long leading, I would say, indicator of the overall dashboard. As Emily introduced, this dashboard has been very, I would say, effective in terms of predicting recessions. I wouldn't say it's foolproof because we have had 2 time periods where the dashboard was not red prior to going into a recession. I would say the 2 time periods where it was not red, though I would say as soon as a recession occurred, the dashboard did turn red, was during the 1973-1975 oil embargo. So you had oil, I would say, propel us into a recession. And then 2020. The one thing I would say about 2020 is the recession that occurred was not anything that was economically led. It was caused by a health crisis. And I will say, coming into 2020, the dashboard had been yellow, I would say, for the previous 3 quarters. So the dashboard was relatively cautious coming into 2020, even though the market, after a very strong 2019, and I would say up until the first 6 weeks of 2020 was relatively strong. We were getting calls from people saying, why is the dashboard still yellow? Things are improving. The market is up a lot. But just, several days later, you started to see the COVID cases go outside of, I would say, the Asia region and hit the rest of the world, propelled us into a global shutdown, which caused us to go into a recession. One of the other things, again, this is kind of the proof point for our recession risk dashboard, is that it also is hopefully helpful to see what the dashboard looks like today and what it's looked like in past recessions. So you can see we're solidly, I would say, more in the expansionary phase than I would say in the cautionary or the recessionary phase. And again, typically what we do see is when the dashboard turns yellow, it's about 8 months prior to a recession. When it turns red, it's usually 3 months prior to a recession. One of the things that, and this is one of our indicators within the dashboard, is the yield curve. And so essentially this is showing kind of the maturities of the fixed income, or I would say yields across different maturity levels within, I would say, the market. I would say probably 3 or 4 weeks ago, people were, I would say, raising the concern about a recession because they saw the 10-year and the 2-year yield curve invert. And one of the reasons why that tends to be, I would say, maybe a red flag is typically when we see the yield curve invert, so the short end go above the long end, recessions typically occur. What I would say in terms of a rebuttal to that is, because there are many different, I would say, yield curves out there. You can look at the 10 and 5s, the 10 and 2s. We look at the 10 and 3-month yield curve, so the 90-day T-bill. And one of the reasons why we look at the 10 and the 90-day T-bill is because the 10 and 3-month essentially have a longer track record than the 2-year, and it has been better at predicting recessions when it does invert. So and the Fed does have a paper about this, so if you want to delve into it a little bit more in depth, that is one other source that you can utilize in terms of which yield curve to maybe follow and look at which is more, I would say, predictable in terms of predicting a recession. And on this slide, what you can see here is those red circles or the burgundy circles is essentially when the yield curve inverted. And then those gray bars are when recessions have followed. And if you look to the far right, where we are today is, and this is at the end of March, the yield curve in terms of the steepness was at 181 basis points. Right now, it's closer to about 200 basis points as of the close of yesterday. So in our opinion, if you're looking at the yield curve as one indicator as a possibility of a recession, the yield curve is still relatively steep on this measure. The 10 and 2 has since uninverted, I guess you could say. It's still relatively, I would say, flat at about a 23 basis point steepness on that basis and foundation on the yield curve. So This is one of the reasons why, if you look at our dashboard, it is still solidly in the green, because this is the indicator that we look at, not the 10 and 2, which has been one of the yield curves that have inverted. I would say one of the other aspects, if you look at the steepness of the yield curve of where we are today, and typically what the returns have been able to be delivered from the market, this slide is essentially showing you, and if you see it outlined in this aqua or turquoise or light blue colored box, that is where we are currently in that 100 to 200 basis point steepness of the yield curve. Typically what you've seen 12 months from now and 24 months from now are relatively favorable returns from the market. Even if the yield curve flattens a little bit, it tends to be favorable. When it becomes less favorable is basically when we get to that flat to inversion. So we do believe that we are still, if you look at it on a yield curve basis, have the ability to have, I would say, positive returns with the equity markets. Now, one other thing that we've gotten questions on it and people have been talking about has been inflation, because in my 25, 26 year career, I've never really had to combat inflation. And I would say most people that have been involved in the markets over the last several decades have not had to confront inflation like we are today. I would say the positive side of this, and this is what this chart is sharing with you today, is that we as consumers are, I would say, less susceptible to these energy spikes that we're experiencing. I would say one of the reasons why we state this is, if we look at the last time where oil was at the price level that it is today, it was essentially about a decade ago, 2011 to 2014. Essentially, the amount that we as a consumer spent on energy cost about 3.7% of our income. Today, it's about 2.5%. And so I would say that's a function of two things of why it's, again, it's not fun to be paying more at the pump if you have an internal combustion engine, which I still have, but the impact to me is a little bit less than what we've actually experienced about a decade ago. It's only 2.5% taking up of my income versus 3.7%. And part of that reason has to do with the fact that we have, I would say, consumers' net worth is up a lot higher than it was. It's up about 30% from pre-COVID levels, so just from 3 years ago. And then I would say the other side of it is that we do have more fuel efficient cars. So I'd say over the last decade, the fuel efficiency of cars has increased by about 7%. So combining those two has been, I would say, helpful for the overall consumer that we have out there. Maybe one other thing that I would talk about, and this is a couple of pages in, so I apologize for flipping through. But one of the other things that we've been talking about, and again, the first part of the year has come, I would say, with choppy type returns that we've expected. My first slide that I shared with you is, even though we tend to have positive returns, again, not every year is positive, but to endure the returns of in a full year, we do experience a period of, a 10% pullback or so. What we would say is this year might be a little bit more choppy than those average returns that I shared with you earlier, largely due to the fact that we have midterm elections here in the United States. So essentially what this chart is showing you is that during midterm election years, you tend to have a little bit more volatility or choppiness within the markets. In my previous slides, I would say outside of midterm election years, typically you see about a 10% correction intra-year. What this is showing you is that on average in midterm election years, you could have close to a 20% correction within that year. I will say the positive side of this is typically what you've seen from that trough and 12 months out, so a year later, the average return 1 year later has been on average of about 32%. And typically the catalyst that I would say that kind of ends, or maybe is the catalyst for that event for the market to stop going down, is actually the midterm elections, because then I would say there's a little less uncertainty, because now you know who's going to be voted into government. A lot of people have their track record out there if they're not a new candidate. So people understand how they typically would vote and progress on regulatory and other items like taxes or healthcare and those types of things. So what I would say is what we're going through today is something normal that we do experience. We still believe that we're in a secular bull market. So we do expect to continue to see positive returns. What I'd say is this year, it might be a little bit harder, obviously with the market being down, but tougher type returns. So we're not expecting, the 20 or 30% returns that we've seen over the last several years, but do expect to have, I would say positive returns, but probably more in the single digit area versus, I would say the double digit. And just to finalize my talks before opening it up to questions, looking at it from the economic standpoint and looking at it from the market standpoint. Economic wise, we do think the odds of a recession still remain relatively below average or low, even though we're seeing some things that might be kind of tougher read through. Again, one of the reasons why we do feel, I would say, more constructive is when we do look at the yield curve, especially the 10-year versus the 3-month, is still very, very steep. And we do think as we continue to reopen, as we continue to see, hopefully those supply chain constraints start to lessen, will prove to be more beneficial. And I would say the position of the consumer is still relatively flush with cash. Savings rates are still around 6%. So we do find that the consumer is relatively strong and continuing to return to the labor market. On the market side, so separating the economics from the market side, we do expect choppiness and continued choppiness for the couple of reasons that I shared, especially with midterm elections. We are going from, I would say, an easing cycle to a rising interest rate environment. So we do expect that does cause some, I would say, volatility within the markets. But what we would say is typically these downdrafts are usually good opportunities to be able to add money to your positions. And typically over the next 12 months, you tend to see more favorable returns out there. So with that, I'm going to stop. Carl, Emily, see if there's any questions that I can answer or anything else that I can share on ClearBridge's view.
That was a really good intro. So I'll start. I'll have a few questions, and then folks, if you guys want to go ahead and send any questions you guys have, I'll try to go through and address them as well. You talked a little bit about the NASDAQ being down north of 20% and S&P at call it around 11 or 12%. There seems to be a big push towards a value trade. Mm-hmm. How are you guys viewing that? And then more specifically, just on the growth tilt, do you guys see an opportunity there, or are you guys, still a little bit concerned about where things could go, if the interest rates continue to stay elevated?
So, and at ClearBridge, since as I had my beginning talk, so I do have value, I do have growth. So of course, I'm always going to say both. But what I would say is in the near term, value as a style probably has the advantage on a relative basis. Some of that has to do, I would say, from beginning valuation points. So value, even though I'd say over the last 15, 16 months, value has outperformed growth on a relative basis. We do still think value is relatively cheap. Typically in a rising interest rate environment, especially earlier on, it tends to favor what people deem as short duration assets, which is usually associated with value, versus long duration assets, which is usually associated with growth. That being said, we do have growth strategies. And what I would say about their positioning is, they have different types of growth represented there. But even from, I would say, the value side of the ledger and the growth side of my ledger, is that we don't believe what has driven a lot of the returns, especially if you look at the growth benchmarks, are going to be the same things that are going to drive the returns for the next 3 to 5 years that drove the returns for the last 3 to 5 years. So if I look at some of my growth portfolios, they're actually underweight technology. Where they've been adding to has actually been to the healthcare side. So what I would say is, just stylistically, even though value, I would say, has maybe the advantage, at least on an interest rate environment, doesn't mean that growth can't outperform. What I would say is, getting into this environment, I think this is where active management is actually going to prove its value versus, I would say, rising tides that basically lift all boats. And especially if you were exposed to, I would say, the mega cap and mega cap tech names, that you did very well. And if you weren't, you had a little bit of a tougher time. we do think stock picking, especially in a choppy environment, is going to be much more important going forward.
Yeah, and then I look, if we dive deeper, I guess on the growth side, I mean, you see some of the fallout and, you know, some of the other areas like cybersecurity and fintech. Do you see there, and obviously, I mean, everyone's talking about Netflix is like another one. Do you guys see any opportunity to rebound in some of those sectors? Obviously, I know you mentioned healthcare, but, you know, when I think about those a little bit deeper.
So like cybersecurity, I think is still going to be an area of growth. And if you look at what we would deem as like the chief information officer, chief tech officers, they are continuing to spend. And as you can see, like I'm in the office, you're out of the office. We're still going to be in this hybrid world that we do think cybersecurity is something that's going to be very important. So we do have like a Splunk or Palo Alto within our portfolio. So just because we're underweight tech doesn't mean we don't have certain exposures. Ironically, we do have Netflix in our large cap growth portfolio. And it's been a little bit of a tough ride, but we do believe that name, at least at this point in time, may be, you know, going through a transition for the next 18 to 24 months. And it just depends on people's patience if they want to have exposure there. It's a 1.25% position in our portfolio. So within a well-diversified strategy. What I would say is with some of those names, again, I would lean more towards the expertise of if you see the ability of these companies and liked them before and they've come down in valuation, maybe the time to be able to add to some of those positions. But I would say on a selective basis, I wouldn't say as a monolith as we've seen in the past. So I'd say selectively adding to some of these names. And again, on the consumer side, we have been picking up some names, because of the strength of the consumer and because we are continuing to reopen. And again, they're people that have some delayed, you know, trips that they want. And so we do think that could be something else that's beneficial that we're trying to, I would say, take advantage of within the portfolios.
So like would you be referring to, I guess, like more of the reopening trade?
I mean, some of it, because I would say it depends on what type of the reopening trade. Like we did sell Home Depot out of our portfolio because basically everybody's been home and been doing home improvements to their homes. So a lot of that has been fed forward. But we do own what I would say is Tractor Supply, which is another name that can still benefit from that. We added Nike to our portfolio when they announced in third quarter some issues with Vietnam and supply disruptions. So I'd say we do have the ability to pick and choose in some of those names that have gotten hit dramatically. I would say some other names that, again, that we think are a little less susceptible to a macro environment on the healthcare side. Mm-hmm. Again, the reopening there. Elective surgeries, basically, especially during the COVID shutdowns, went to zero, slowly starting to open up as we continue to move from pandemic to endemic. We do think that's an area where those elective surgeries will become more and more. And so building some exposure to some of those names that could benefit from that as well.
You mentioned Nike, and that just kind of spurred the thought of China. Obviously, with them having elections later this year and their zero COVID policy, how are you guys, you know, looking at the kind of emerging market, international markets, maybe in general? You know, do you guys see that as an opportunity? And then, you know, there's been a lot of talk about potentially a dollar devaluing in the future, which could lend opportunity to the space as well. So maybe any thoughts you guys may have, you know, internationally or, you know, China, obviously with supply chain issues, et cetera.
Yep. So ironically, we do have an international value and an international growth. And what's interesting to me is my international growth portfolio is pretty much taken down their emerging markets exposure to about 2.5% of the portfolio. Pretty much have gotten out of China until kind of the elections and you get a little bit more clarity. My value has been adding to Asia. They've been adding to emerging markets. So I would say divergent views, even with under our own umbrella at ClearBridge. What I would say is there have been opportunities that are allowing us to, I would say, find some names within that area. I would say even outside of China, like what's happening with Russia and Ukraine, basically Europe has been priced for a recession. So I would say my value manager really wants to keep moving west, but hasn't been able to because of some of these things. So it's probably delayed it a little bit. But our view is that there are a lot of markets that are probably getting punished because of macro aspects. But if you look at the underlying fundamentals, are actually very favorable. So I'd say going into it, I would say in a dollar cost averaging way. So the one other thing, and I don't think I have it in the slide deck, but the one other thing is that the international side, if you look at it relative to US, has underperformed for quite some time. So I do feel most people are probably allocated very well to the US and maybe not as much to the international markets. Our feeling is it's a good opportunity to actually add to international. We do think the dollar will, I would say, weaken, though that we haven't really seen that come through yet, but I would say we would expect that to happen over time. The other thing about emerging markets is they are much better equipped to deal with inflation than we are here in the United States. I was actually in South America about 6 weeks ago for my offshore business, and I was in Argentina, I was in Chile, and I was in Uruguay, and just talking about just the price of oil. And we were basically on parity on how much it cost us per gallon versus them on per gallon, which I thought was really interesting. I was like, wow, I don't think we've ever experienced that. So,
Yeah.
But they have also raised interest rates earlier in some countries. So it's caused some of their markets to go down. But we do, I would say, especially on the value side, are finding some opportunities within that space.
How do you guys, and obviously the big issue on a lot of people's mind is the Ukraine and Russia issue. How are you guys kind of planning around that? I would imagine you guys have tried to think through what the plans are for Russia as a whole, whether it's continued expansion or eventual exit. Do your analysts have kind of a general consensus on how they're approaching it from a long-term perspective or short-term, et cetera?
So we did, and this is something I would say in general, we don't have direct exposure to Russia. We have an independent risk group that works with all of our portfolio managers and analysts, and essentially kind of ran all of our portfolios through to see what our indirect exposure to was Russia and Ukraine. And I would say very minimal. If I look at it relative to our benchmarks, they're usually like slightly under or maybe slightly over, like a Pepsi in my large cap value, because they have about 5.5% of their revenues coming from Russia and Ukraine. Had a little bit of exposure, but no direct exposure. Then we also looked at it, kind of the direct or indirect exposure from Europe as well, because obviously that's been impacting Europe more. So what I would say is just trying to, I would say, understand what the impact could be from the disruptions from Russia and Ukraine. I wouldn't say it caused any of our portfolio managers to change anything within their portfolio, because again, I think the one thing that's really hard to do is predict the future. Again, our dashboard is to help us kind of understand where we are in the cycle. So I would say nothing that's changed in terms of how the portfolio managers, even on the international side, position their portfolio. Again, as I said, for my international value, it's caused them to maybe be a little bit slower to adding to Europe within the strategy until things get a little bit more clear. One thing that I will say is that you could see that it's actually increased, I would say, the need for, I would say, energy security. So where you're sourcing your energy. Again, if you're looking at the natural gas side and where Europe is going to source it, that could be coming from the United States. So could benefit some of the companies that we have within our portfolios. And then I would say energy transition. So I would say access to alternative or renewable type energy, moving that more quickly to having that happen. And again, we have the ability to have exposure there. So I would say it's a lot of different things that it's impacting. It's probably impacting inflation as well and continuing to cause, I would say, some disruptions within the supply chains. China, if you look at Shanghai being pretty much shut down, Beijing is kind of going through some of their, I would say, issues. Taiwan is at the highest levels they had of COVID cases now. So what I would say is any, I would say, variants or things or disruptions from COVID just might elongate how long inflation or the global supply chain takes to work out. I wouldn't say it's causing it to stop, but all I would say is it's delaying, I would say, normalization.
How are you guys thinking about maybe where the 10-year and CPI might finish, like this year and then maybe into 2023? I guess the biggest concern is really how, I think for a lot of folks, is how much Powell and how many times he's going to raise rates, et cetera. And obviously that's putting a pretty big damper on the market. Are you guys maybe in the camp that they're not going to do as much as he says, or, kind of what are your thoughts there?
So we don't try to deviate. I would say we're with consensus in terms of how many rates are going to be, I would say happen over the next, I would say probably over the next 6 to 12 months. So I wouldn't say we deviate too much from that. 50 basis points was basically priced in before Russia-Ukraine happened. And then in March, we only had a 25 basis points. I would say for the most part, 50 basis points is being discounted for the May timeframe. So I would say we do expect rates to go up. I think there's 8 or 9 rate increases priced in. So I would say as long as the trajectory remains that way, I think the market can digest it. It's just the beginning time period where I would say the market sells off typically coming into, I would say, a tightening aspect, usually 3, 6, 12 months later. As it's digested, you do see favorable returns out of the market. So I would say while we're in it, will continue to be choppy, but typically the longer term, if you look a year out, you tend to have, I would say, positive returns post the beginnings of a tightening cycle.
And then maybe just big picture, obviously this all revolves around inflation. If there's any areas just for the folks listening in that you guys really find to be, good areas to target, obviously you mentioned healthcare. Any other areas in particular that you think could be excellent opportunities over the next 12 to 24 months for them?
So energy, I would say if you look at the value side, energy is something, I would say legacy energy, but also utilities probably that have the, and industrials that have the exposure to the energy transition. So I would say those are a couple of areas that we've been finding opportunities to have exposure to within the portfolios. I would say the other side is selectively on the consumer side again. So I'd say between the consumer, healthcare, energy are a couple of areas where I would say we've been able to find some good opportunity sets given what's going on in the markets today, and valuations where we're finding the best, what I would deem as upside type scenarios from where they're trading today.
And then the last two that I have on my end is from a commodity perspective. I was heard Jeff Dunlop recently, sees this as a commodity super cycle. How are you guys looking at that? And then I think for a lot of folks at home, real estate's another area, with the rising interest rates, just where that market may be going, and how if you guys have a viewpoint on that.
So on the energy side, I would say we probably lean towards agreeing with him on the, I would say, energy super cycle, largely due to the fact that supply has been so constrained. Mm-hmm. And you still see it constrained, especially if you look at the legacy energy guys. They're not spending like they typically do. And one of the other things is that we do think as we're going to energy transition, it is very labor and very material intensive. So would tend to agree that we are probably in an extended period of time. But I would say not just for energy companies, but there's several other areas that would probably benefit from this. And then you have the infrastructure side, which again, I would say around the world, people are trying to not only, I would say, tackle, I would say inequality, but also the climate. So those would be, I would say infrastructure spend, energy transition are some of the things that I would say are building there. On the real estate side, again, I would say things aren't as affordable as they were 2 years ago. I will say where rates are today are still relatively favorable on the affordability side. Home prices have gone up pretty dramatically. So if we continue to see rates go up, I would expect to see a little bit of cooling within the housing area, but I wouldn't say it's going to drive it to negative, because when we went through the global financial crisis, we basically shut down that area and weren't even keeping up with the growth of demographics. And everybody talks about the millennials. You are starting to see them come off the sidelines and actually have household formation. So I would say it would probably slow it down a little bit, but I wouldn't say it would crater it to the levels that I think some people may get concerned about.
No, that's really, really helpful. All right, well, I'll go ahead and if anyone wants to send any questions in here for the last few minutes, to go ahead and add those to the chat right now, and then I can go ahead and ask Kathleen. I'll give everyone a couple minutes.
And I did respond to the question. If you are interested in getting the slides and a link to what Kathleen is talking about, we can send that via email to anyone participating. So just let us know.
Yes, so our anatomy of recession, if you go to the Franklin Templeton's website, we do have all the acronym we use for it is AOR, so anatomy of a recession. It has the dashboard in there. In this presentation deck, we usually update it on a quarterly basis, but we do have a monthly update as well, which you could subscribe to. The other thing is the dashboard. We have what I would deem as an interactive dashboard, so you could see what would stress or improve each one of these indicators. So it kind of helps you understand what would move the dashboard from a green to a yellow overall if you, I would say, out of those 12 indicators, move them around. So happy to share that. You can go on the website and I would say have an interactive I would say experience with our dashboard to see live how it does change over time if those indicators weaken or strengthen.
And then maybe I have one other question for you. So there's a lot of talk about the 60-40 portfolios. How are you guys thinking about that? Because I've had plenty of folks that are nearing retirement saying, what do I do? Do I go to cash? Do I stay invested? I'm going to need money and I'm potentially going to lose on my bond trade. So how would you guys kind of put that out to those folks that want to, kind of preserve capital, but not get run over by inflation?
So we do have a sister SIM, Western Asset, does much more on the fixed income side. We do manage balanced portfolios with them. We pretty much do the equity side. They do the fixed income side. So, and I'm a huge asset allocator. So I'm always, what probably happened is those 60-40s probably went to 50-50 or kind of inverted, because I think most people probably built up some of their fixed income exposure. So if you're out of whack, I would usually recalibrate. The one other thing, if people are concerned about the fixed income side, so as many people may or may not know, it's an inverse relationship. So as interest rates go up, your price goes down, and then the opposite. So we've been at historically low interest rates, so interest rates are going to be going up. So on a bond, it might be, unless you hold it to maturity. One other way, and again, this may not be answering your question, but one other way, if you're concerned about the fixed income market, is look for dividend paying type companies or income, equity income type strategies. We do have one called Dividend Strategy, where, again, if people are concerned about inflation, we tend to look for companies where we won't pay like a huge upfront yield. Usually what we're trying to do is yield 50 to 100 basis points ahead of the S&P 500, which we're about 80 basis points ahead. But I would say the second objective for that strategy is to find companies that are actually compounding that growth of their dividends. So in an interest rate environment, rising interest rate environment, and an inflationary environment, it helps you to kind of offset or hedge out a little bit of that erosion from inflation. And I would say that the other side of it is it does provide some downside protection. They tend to be less volatile type stocks. So I would say always keep a diversified portfolio. I know it's a little bit tougher. Usually, fixed income's outperforming. Sometimes equities aren't doing as well. So it kind of, they'll balance each other out. But if you are concerned about the fixed income markets, you can look at an equity income type product. But again, on a risk basis, it might be a little bit different on your risk profile, but does provide some benefits there.
Thank you. Perfect. Well, I appreciate all this wealth of information. Is really, really helpful. Kind of just quick summary for the folks listening. I think, as she mentioned, there could be a great opportunity to really target the energy space as well as the healthcare on the growth side, and obviously look for companies that have strong balance sheets if you're going into the tech side. But we'll go ahead and get out the slides to everybody that joined. And if anyone has any questions after this meeting, feel free to reach out to Emily or myself. And, we're certainly glad to be a resource, and we'll definitely lean on the expertise of Franklin Templeton and ClearBridge. They're an excellent resource. And if you guys haven't checked them out on the personal level from their just information or their funds in general, I would definitely recommend that as well. So Kyle, Kathleen, thank you so much for the time, and we definitely appreciate it.
Thanks for everybody sharing your afternoon with us.
Yeah. Thanks, everybody. Hope everyone has a wonderful day.
Same to you.
All right. Take care, guys.